Alright, I'm on CNBC.com right now, and we all know that Janet Yellen talked to Congress today, or from individuals from the House Financial Services Committee, and the headline says, "Bad jobs report won't change tapering." And that's what Yellen's basically saying. Well, it's in my belief that what's going to end up happening is that because we have an overextended economy, you're probably going to see credit problems arise somewhere in the emerging economies. And as a result, you're going to see some of these economies start to print money, continue to expand the monetary base or the money supply. And it's in my belief also that Janet Yellen is going to do the same thing, and she is going to increase the amount of mortgage-backed security purchases and treasury purchases. Alright, so now I want to look at this chart over here, and this looks at, first of all, the oil prices versus the Fed funds rate. And we have to realize that the Fed funds rate in August 2007, you could see in the blue, you could see is roughly around 5%, okay? And this is actually 5.25. And if you look at the oil price, it was close to 70 some dollars a barrel, okay? And these are just averages for the month, by the way, when it comes to the oil prices. And when you saw Ben Bernanke lower the Fed funds rate, right? Some people may say that is like unwinding the tapering right now. Whatever you want to call it. Fed funds rate went from 5.25 to roughly 0% sometime around Lehman Brothers. And if you want to look at oil prices, they went from $70 a barrel all the way to roughly $144 a barrel. This graph doesn't show it because it's using averages, but this is the graph that I made. And in my belief, we're going to have another oil shock in 2016. I'm going to show you my thought process behind this. Alright, now let's look at this oil graph, which is from the St. Louis Fed website. And if you want to look at oil shocks, they usually happen around election time, and they obviously cause recessions, or a lot of these have been causing recessions ever since World War II. If you want to look at recent history, let's just go back to 1979. What happened here? You had oil just skyrocket in the late 70s to 1980. You had the Iran situation going on, the hostage situations, and that did not help. You had the weak dollar in the United States, and the dollar pegs did not help in Iran as well, so they threw fits. So as a result, oil prices went up, and you have to remember Jimmy Carter versus Ronald Reagan. Who won? Ronald Reagan. If you want to go back to 2008, another recent oil shock, what happened here? I showed you. Fed funds rate lowered from 5.25 all the way down to 0. And this caused not a run on the dollar, but it caused the dollar to go down, oil prices to go up. And it's in my opinion, the next recession is going to be like that again. And I'm going to show you some technical analysis done by this one trader that I noticed in December of last year. And for those of you that are technical analysts, please let me know what you think of that graph over there. Remember, I use fundamental analysis when I'm looking at all this information. I do look at some technical analysis, but for the most part, it's fundamental analysis. Alright, so now this was the oil price chart off of Greg Harmon's site. I think he must have removed it, and I did take a video of this a while back, or a month or two back, but this is what this trader said. He said that there's a trading pattern AB equals CD, and this is the graph of oil. So oil was like $20-$30 a barrel, right? And in, what is it called, the year 2000, 2001. And we saw this spike over here. You see this pattern B at $144 a barrel, which I showed you before in 2008. And then we saw it go down here, right? 2009. And the price was roughly $38 a barrel. That's what was, excuse me, that's what it was in late 2008, early 2009. And this trader is projecting in the next few years that oil prices are going to skyrocket to match this AB equals CD pattern. He is using technical analysis to project the price range, and he came out to $163 a barrel using his metrics. And when I look at fundamental analysis, I've looked at the fact that many of the recessions have occurred due to oil shocks. And it just looks like we're at the end of the cycle, or close to the end of the cycle. And because of Janet Yellen, it's in my opinion, she's going to unwind the taper sometime in 2015 because credit markets start to get out of control, especially in emerging economies. It's going to affect us in the United States. She's going to unwind what was done. As a result, this will create dislocations like it did in 2007, 2008, and you're going to, in my opinion, we're going to see higher oil prices. It could be because you see a weaker dollar, or B, you may see people in the Mideast throw a fit because if they're seeing, if there's tension going on and you also have more money printing, they have dollar pegs. So because of the dollar pegs, they're going to face nastier inflation. So that's why I see many reasons for this trading pattern to actually occur. Okay, and I'm looking at it from a fundamental perspective. This trader is looking at it from a technical analysis perspective. So that's something to note. Anyways, guys, leave me your thoughts. What do you think about the coming oil shock? Let me know. Thanks. Bye.